Here's everything you need to know about rental yield. Rental yield measures the profit that you generate each year as a percentage of the value of your property. Investors use rental yield to evaluate the income they generate from their property, but also to compare various investment properties. A high rental yield results in a higher cash flow, and this helps to improve the return on investment. So how do you calculate rental yield? Well, there's two types of rental yield: gross yield and net yield. Let's start with gross yield. Gross yield is simply taking the total amount of rent that you receive on your property and dividing that by the property's price to generate the rental yield. Let's look at an example. Let's assume you bought an investment property for $600,000. And that property is able to generate $500 a week in rental. The annual rental, 500 times 52 weeks, is $26,000, which when divided by the property price, $600,000, leaves you with 4.33% rental yield. Good on you. That's gross yield. And note that the property price can either be the purchase price that you paid for it or its current market value. Now, net yield is almost the same equation, but you deduct from the annual rental any of the expenses that you may have incurred in maintaining and managing that property. And these can include repairs and maintenance, strata levies, council rates, and insurances. This will obviously give you a slightly lower percentage, but this is your net yield on your property. So this begs the question, what is a good rental yield? Again, it differs from state to state and location to location, but as a general rule of thumb, in the metropolitan areas, you should be looking to generate between 3 to 5% rental yield. Bottom line, rental yield is a very useful tool in the investment property decision-making process, but it's not the only metric you should use. And as always, do your own research. Like or share for more tips.